Will stocks be able to go up if the yield keeps going up? If only we had a guest like that on.
We do. Lucky us. Sam Stovall joins us, CFRA Research Chief Investment Strategist. Sam, you worried about the 10-year yield as a barrier for stocks?
Good morning, Sarah. Morning, Brian.
Good morning.
Yeah, I think that it is something that is going to be the headwind. I mean, we are going back to where we were about a year ago. Remember, we were at that 5% threshold a year ago, but we were able to overcome that concern. I think that the market is a bit concerned about the inflationary numbers. I think the data that will come out in January for December will also show a little hotter than expected growth. But I think as we move into 2025, we will likely end up seeing both CPI and PCE start to track lower once again. And as a reminder, the 10-year yield has averaged about 5.75% since 1953. The CPI and the headline and core CPI about 3.75%, and PCE has averaged about 3.25%. So we're below all of those levels right now, even if we do move up with the 10-year yield.
So if the yield, Sam, gets to 5%, can Nvidia still trade at 39 times forward earnings? I'm asking for about 1 million friends.
Yes. Well, right now we're looking at the market and technology trading, I believe, at pretty high levels, certainly not at the most extreme levels, but relatively high. The S&P is trading over the past 10 years at a 22% premium. Over the last 20 years, it's a 40% premium to its average forward PE ratio. Tech stocks are trading at a 43% premium, currently at 10-year average, but a 65% premium over the last 20 years. So, yes, we are looking at pretty expensive valuations right now, but it seems to be the only game in town. And as Brian mentioned before, the market's not trading necessarily on valuations, it's more on momentum.
Sam, I cited you yesterday in talking about how important this Santa Claus rally, whether it comes to fruition, is for January and for the coming year. Just review the historical data for us about why we should care.
Sure. Well, this is data popularized by the Stock Traders Almanac. Santa Claus rally, if we are up in the last 5 days of 1 year, first 2 days of the next year, the average gain is 10.4% for the coming year, rising 74% of the time, which is really just a shade better than the market as a whole. If, however, the Santa Claus rally fizzles out, the average gain is 5.7%, with only about a 1 in 3 chance of the market being higher. I really lean more toward the January barometer. As goes January, so goes the year, because there you're talking about real differentials. A positive January, especially in a first year of a president's term in office, the market gained 91% of the time, rising more than 18%. But if we did not get the January gain, the market was down 2% on average for the full year and rose in price only 1/3 of the time.